All right, we're going to talk about a company that has this massive contradiction right at its core. You've got NextNRG, and they are posting some of the most just unbelievable growth numbers you'll see anywhere. But hiding right underneath all that success, there's a huge gamble playing out. So let's get right into it.
First, just look at this number, 226%. I mean, let that sink in. That's NextNRG's year-over-year revenue growth for one quarter. That's a staggering figure, and you can bet it's got Wall Street buzzing.
And that brings us to the big question, right? Is this kind of just explosive growth actually sustainable? Or is it hiding a much, much bigger problem? That right there is the high-stakes gamble we're going to unpack.
Okay, so let's start with the good news. And believe me, it is very good. The company's top line, their sales, they're on an absolute tear. And you can see just how dramatic that growth is right here. We're talking a jump from just under $7 million in Q3 of last year, all the way up to nearly $23 million in the same quarter this year. That's more than tripling their revenue in just 12 months. Wow. And what's really interesting is that this wasn't just, good growth. This was way better than the experts predicted. The consensus on Wall Street was for revenue around, $20.9 million? NextNRG just blew right past that number.
And to put this into an even bigger perspective, if you zoom out, their revenue just through October of this year has already hit almost $66 million. That's more than double what the company made in the entire previous year. The momentum is it's undeniable.
But, like we said, this incredible growth story comes with a pretty big catch. So it's time to flip the coin and look at the other side of the financial picture. So this slide really lays it all out. You see that awesome revenue beat at the top, which is fantastic. But then you look below that, a net loss of nearly $15 million. And a gross margin that, yeah, it's improving, but it's still pretty modest 10.7%. And here's where it really stings. That net loss, it translated to negative 12 cents per share. Now, Wall Street was expecting a loss, sure, but they were thinking more like 5 cents per share. So while the revenue was way better than expected, the losses were more than double what the analysts had priced in. Ouch. So what's going on here? Well, this is a classic case of what you'd call early-stage growing pains. You got to spend money to make money, but scaling a business this fast costs a ton. You've got operations, stock compensation for your employees, and right now, all those costs are just outpacing the profits from their sales. Okay, so this brings us to the most important part of this whole story, the company's plan to actually fix this. They believe they have an ace up their sleeve, and it all comes down to technology. At the very heart of their strategy is this integrated tech platform. Management is betting that by using their own proprietary systems, like their Rencast analytics to predict energy demand and the NextUO system to run everything super efficiently, they can unlock much higher margins and ultimately create more value for their clients. And look, this isn't just some theory in a PowerPoint deck. It's already happening. Their tech-forward approach is translating into real-world deployments, like a massive 300-acre warehouse development down in Florida that's using their entire ecosystem, from solar microgrids all the way to EV charging. Now, a huge piece of their current success is this subsidiary called ESFIL. Think of it as their anchor client model. It's providing mobile fueling right now, and it's generating a ton of cash flow, over $36 million in volume in the first half of the year alone. So that cash, it doesn't just fund the development of their high-tech future, it also gives them this built-in customer base to eventually transition from today's mobile fueling to their full electrification ecosystem tomorrow. It's a really clever bridge from the now to the next. So with this tech-forward plan in place, what does success actually look like? Well, the company has laid out a pretty bold roadmap, and they've basically circled 2026 on the calendar as the year for a major payoff. Here's how they see it playing out. The rest of this year, it's all about keeping up that insane triple-digit growth. Then, in early 2026, the focus is going to shift squarely to improving those profit margins. And the ultimate goal? To hit break even, where the company is no longer losing money by the end of 2026. Now, you're probably asking yourself, is that goal even realistic? Well, a little context from competitors helps here. A company like Blink Charging, they've recently gotten really close to break-even on a similar amount of revenue, and that suggests that NextNRG's target, while definitely ambitious, is not some crazy pipe dream. It's within the realm of possibility for this sector. And if they pull it off, well, the reward could be substantial. Some Wall Street analysts have set their 12-month price targets as high as $6 a share. So what does that actually mean for an investor? Well, with the stock currently trading at around $2, a $6 price target implies a potential upside of somewhere between 170 and 200%. That is a massive potential return, but it all hinges on one thing. And that's this: execution. The strategy is there, the technology is there, the growth is definitely there. But none of that matters one bit if the company can't execute its plan to control costs and expand its margins. It really all comes down to execution. Which leaves us with the final big question. Will NextNRG become the profitable, high-growth disruptor it wants to be, or will its story end up as a cautionary tale about the dangers of growing too fast? There's a really fine line between the two, and you can be sure that investors are going to be watching very, very closely to see which side of that line they land on.